Welcome everyone to the Elephants on Business podcast, improving your small business journey one episode at a time. Today we're going to deep dive into the different ways to pull out money from your business for personal use. And the two main ways are through wages and, depending on your business structure, a dividend. The key things we're going to discuss are what are the key structures of a wage, what is a dividend and how does that work, why would you choose a wage, and then the other option of why would you choose a dividend. And right at the end of this episode, we will discuss just the two major questions that we get asked all the time, or Oz gets asked all the time. Welcome, Oz.
Yep, great. It's great to be back.
We're talking technical accounting stuff, your favorite topic.
Back to technical accounting. We've done various episodes on, just small business in general.
The life of a small business owner.
We're coming back to more of a tax accounting question that we get asked quite a bit.
And the reason that we kind of are doing this is because it's such an important thing. You start a business because maybe it's lifestyle, maybe you want to do something big. And then the question obviously is that, well, how does, from the business account, how does it get to my account? Because I want to do great things in my personal life.
Yeah, correct. So this discussion is more about companies in general.
Yeah.
So when you've made the decision to elevate your small business into a company structure, company structure is a separate sort of legal entity. And essentially, when you draw money out of that company, we have to classify that from an accounting point of view. What type of funds are drawn in a sense, right? So then, they can be classified as a wage or a dividend. So,
and are they obviously the general two ways that you see funds flow out of a company?
Yeah, that's generally the two ways that we would sort of structure those payments out. So, the key structure of a wage is there's we have to register a person the company for STP.
Yeah. And what is STP?
So that's called single touch payroll. And essentially it's a system that you use in your accounting software to declare that wage to the person running the business, right? So they get added in as an employee of the company, and essentially they can draw out, technically a wage. And it's the same as if you were just working for an employer, right? So
that employer would have registered for STP on their end.
Correct.
Done all this stuff, and then you're off and running.
Yep. So then you're on the system, and then essentially when you draw that wage, there's tax that needs to be accounted for.
Yeah.
And then there's obviously super as well. So super in this financial year is 10.5%. So any wages that are drawn, you essentially have to pay for that super.
And I remember that, when I changed jobs in my career, I had to sign all these forms, declarations. Did I have student loans or HEX loans, all that kind of stuff? Is that the same if you're the owner of a company?
Correct. Same principle. So you still fill in your TFN declaration.
Yep.
We work out, do you have HEX debt loans, and those things. And then obviously a super choice form as well. Work out where your super fund is, put all those details into the system, and essentially, work out a wage that's going to be sustainable for your company based on cash flow.
And do you typically see business owners transition to a wage early on in their business life or later on in their business life?
It's generally later on, once there's more business profits and a little bit of stability. At the start, the question always is, how am I going to pay a wage when I don't know, the cash flow of my business potentially? Most of the time when a sole trader is transitioning into a company, there is probably some stability there.
Yeah.
But they probably still are a little bit scared to go, okay, let's not do a wage for now. We might just turn it on in maybe 3 or 6 months' time down the line.
When they feel comfortable.
Yeah, when they feel a little bit more
comfortable.
Well. There's some cash flow coming through. They've done some invoices and stuff like that.
And I guess if you don't feel comfortable about consistency of paying yourself out of the account, that's when a dividend kind of comes into effect. That's an option.
That's an option. So you can still draw out funds as you please to use personally.
Yeah.
And we can structure those funds on the accounting basis to show that was a dividend. Now, generally, the key difference is a wage is generally an expense for the company.
Yeah.
So if you just look at the P&L, you've got your income and expenses. The wage will sit within those expenses and reduce the profit of that company.
Just like other expenses, rent, subscriptions, software, and other staff wages. If you have staff, when you're a director or the owner of a business and you have a wage, it just gets lumped into
Yep.
that section of expenses.
Expenses, yeah, correct. So then it means then the profit of that your company is actually reducing. So you pay less taxes on the profit.
Yeah.
And then the wage, you have to pay taxes in your personal name.
Yeah. Okay.
Now, during the year, the taxes on those wages are remitted through those bases because you're an employee. Yep. So typically, you receive your income statement, it's called, or back in the days, it was payment summary.
Yeah.
And you would just put that into your personal return. And there's obviously your wages that were drawn plus whatever taxes that were remitted. And then you complete your return. Now, most of the time, we do like try and aim for a way, like if you're on zero taxable income and your main source of income is your business, you try and aim for at least 45,000 in wages,
and
like typically, because
I've been on that
that's
before
that
when I started,
cents.
and so why is it that 45 grand is the figure that I always see?
Yeah, so like that's the base minimum that we recommend. The reason for that is the first 18,200 is zero tax in an individual's name.
So,
and then the next lot up from 18,200 to 45 is 19 cents. Now, if that profit was sitting in the company, you're paying 25%. Even if you made $1 profit, it's still 25%. So you do want to potentially pull it out and have it against your name.
You know, for people listening out there, it sounds very technical. Oz, maybe we'll just go through a very simple example. We won't go through the intricacy of numbers, but if I had a business that was $500,000 revenue in the year and I had all these expenses that was 400 grand,
yep.
I hadn't paid myself a wage or anything. So what that meant was there was about 100 grand of quote profit left.
Yep.
Now, what we're discussing in this episode is how to get that profit out to yourself.
Yeah, to use for personal means.
And we're trying to do it theoretically in the most tax effective manner.
Yeah.
And so the options that we're discussing is you've got 100 grand, you can go, I'm going to take 100 grand wage out. What that does is it comes out of the company, and like jump in any time because I'm not letting you count, but it comes out of the company and it goes into your personal name. Then you're taxed based on the certain Australian tax brackets.
Yes.
Is that right?
Yes.
And
based on your personal,
the higher your personal income, obviously, unfortunately, the higher the tax is.
Correct. It scales up.
Or the other option is you keep it in the company. However, instead of scaling up like you would in your personal name, there is a flat dollar figure.
Yeah, it's just a flat 25% then.
And this is where, I guess, the value of an accountant to help you understand where, well, you can put a bit in your personal name at this tax rate, or you can keep a bit in your company name at this tax rate, and you can kind of get the best of both worlds.
Correct. And
get your money out or keep it in the company, but also pay as little tax as possible.
Yeah, and that's the point of tax planning, right? So to work out what do you need personally, and what are you generating in your company, and to sort of marry those two things up and have it in that sort of tax effective environment.
And so if we go on to just those two scenarios and we start off with a wage, why would someone want to go on a wage?
So generally, like, people pick it because it's stable, right? So you will know essentially per month I can draw out X amount and I'm happy to live off that amount personally.
Yeah.
And essentially, if there's greater profits that are left, then you can deal with that towards the end of the financial year. So like you might progress through the first maybe 6 to 9 months on a very stable, easy wage, comes to your personal account, you know what you can spend because the tax is already taken care of via the company remitting the tax. So it makes juggling your personal life a little bit easier.
And I guess the key word you mentioned was stability. So and you mentioned that whole word tax planning. If you're sitting down and as part of your process of tax planning, you sit down with your clients and you say, what does the next 12 months look like? And I would say, Oz, it looks like, let's say an example, 500 grand turnover, 400 grand expenses. I've got 100 grand. Is that when you start going, all right, cool, let's talk about options. We can put you on a wage because we know that you're going to make 100 grand. You're pretty confident we might set you on a 45 grand wage, and then we'll deal with the rest later. Maybe it's more, maybe it's less. Is that kind of the whole concept of tax planning?
Yeah, that's the whole concept, right? So you'll decide what's the bare case minimum for you to live off personally. What are sort of the wages that are required to sustain your mortgage, your family, etc. and then based on that, we can deal with, whether or not we can take a dividend or wages. Now, you don't have to pick one.
You can do both.
Or the other. You can do both. You can have a system where, you pay dividends towards the end of the financial year when there's some profits there based on last year's profits, and then have your base wage.
And, when I started a business and cash flow was lumpy, I got a bit stressed thinking about putting myself on a wage.
Yeah.
But there is a point where, correct me if I'm wrong, as a small business owner, and I've had happen to me, you get a bit addicted to reinvesting in your business, reinvesting. And time can pass and you just look at your personal life and your personal budget and you go, geez, I haven't pulled out much, or why is my wage nothing, or where's my savings balance?
Correct.
Is that kind of the wage also keeps you honest to run the business effectively?
Exactly. So it keeps you honest, like for that drawdown, and it also keeps you honest from a superannuation point of view. Like as small business owners, you typically avoid that, but essentially because the wage forces you to pay super, at least then you're accumulating a bit of your super balance as well on the side.
And every dollar counts in super. We always talk about the effectiveness of super at retirement, and people just think that, it's a thing, but it's just set and forget, and it works really well. And so not going on a wage, you can risk not putting into super.
Yeah, that's right. Because when you're on that wage, you're forced to do it, so it's a good mechanism to keep you honest, I guess.
If you flip it and go, all right, so then I don't want to go on a wage, I'd prefer a dividend.
Yeah.
Why do people go on a dividend?
Yeah, so dividends, generally there's two types of dividends, unfranked and franked. We generally use the franked dividends, and what that means is the company's made some profits in the prior years, and we're able to access those profits to pay a dividend.
Yeah.
Now, dividends don't hit the profit and loss the same as a wage, so it's not the same.
It's not an expense.
It's not the same way as the wage, where the formula isn't revenue, expenses, profit, and the dividend's not within those expenses. So dividends are generally paid once you've made some profits in the prior year, and we want to flow out some of those profits, right? From a cash flow point of view, you can take out the funds before.
And that was the question, right? I think people get worried that a dividend is, oh my gosh, I'm going to run this business for 12 months and I'm only going to take money out once a year. That's not the case, right?
That's not the case. So you can take out the money as you go. Generally, there's what we call a director's loan account attached to a company.
That accounts for the money you pulled out, and then you're dealing with it at the end of the year by declaring a dividend out.
Correct. So we can balance it out at the end of the year and determine, sort of, are we in a deficit? Like, is it a debit loan? And then do we need to deal with that? And that's part of the tax planning session as well. Have we drawn out more funds than what we've declared as wages? And if so, can we declare a dividend based on, has the company been running for multiple years and paid some taxes? Then we might declare a dividend to clear that out.
And obviously, there's so many complexities to this, right? Can you pay a wage to your partner? Can you declare dividends to other people? Can you have a trust? All this kind of stuff. But what we're dealing with in here today is the very simple model of declaring a dividend to the owner of the business.
That's the problem, right? So like
it spirals, right?
You can have a shareholder that's a trust, right? So then essentially you can say, let's declare a dividend. It goes into your family trust, and then you can stream out those profits to multiple family members and utilize multiple tax brackets. And any prior tax that the company's paid is also flowing out with that dividend. So if you're running a small business, it's generally taxed at 25%, goes into the trust, and then from the trust it will go out to individuals
that you
and
choose.
Then 25% sort of tax also goes out. So
but
that's also part of the tax planning session, and to sit down and look at your structure, see who's in your family business, if your husband and wife,
or your partner, and all this kind of stuff. Kids.
And that's when maybe a dividend is more suitable for you, because we can flow it through maybe a trust, and it's going to go to the two members of that business.
And with a dividend, so if we take that example again, there's $100,000 profit. I didn't choose to take a wage, so my profit is that $100,000, and I go, I want to declare a dividend. Can I also tip into super, or does that work? Or can I not? Or how does it work with a dividend?
So with super deductions, you can do personal super contributions. Obviously, you need to seek
Financial planner,
get some financial advice. But essentially, if from a tax point of view, you can pay into your super fund. Generally, you complete a notice of intent to claim form, and it's basically a form declaring that the contributions that I've made into my super, I want to do a tax deduction in my personal name. So then the deduction will be in your personal name against the dividend that you drew out. So there are ways. So there is ways to also keep you honest on your super fund side.
Yeah. And without putting the stress of monthly doing it and all that kind of stuff.
Yeah. So you can always do it at the end of the year, but once again, that's maybe a financial planning question. Work out what your strategy is, from a super point of view. From a tax point of view, you can do it when you please.
And I think we probably answered the two main questions through the conversation, but I'll go through them again. Do you need money in your bank account to pay those wages every month? That's the question I get asked. So I've got money in my bank account, I want to pay a wage, but I'm worried about what the future might be. When I set myself on a wage, money goes out every week, fortnight, monthly, however you determine. Can that change? Can I change that halfway through? I'm like, business is not going well. Now I'm stressed. I don't have money to pay myself.
Yeah. So any of these options can be changed at any point in time.
Yeah.
You can adjust your wage down or up depending on
how business is going.
How your cash flow is going. Generally, we do recommend obviously setting the wage quite low, and as you progress through, it's very easy to adjust if there's extra savings in the company account and things like that.
And that's where maybe bonuses and all this kind of stuff you can pay to yourself later on. So, and then the last one we kind of discussed, right? This is a variable decision. Like you said, you can add a trust in, you can pay wages, bonuses, you can not pay wages, you can reverse the wage, you can pay the dividend. The summary from your point of view from a client is really, the summary from both of us is, make sure you take care of yourself personally.
Yeah.
Right. That's really, really important for you. Just your general mental health, making sure your family's taken care of, and don't stress too much about the way it happens. Just make sure you have a good tax planning process.
Correct. And the structure in place, right? So like, does the structure work for your family's needs, right? So if you have the company, have we thought about a trust, and things like that. So, you just need to make sure the structure is in place. Make sure you do a bit of a tax planning before the end of the financial year to determine how much money you've actually drawn out and balance those things out. And obviously, speak to your accountant and always look at your numbers and look at your budgets and forecasts. And then you budget and forecast,
right? Be ahead of the curve and then engage if you need to the accountant, obviously all the time, and engage with financial advisors if you need more kind of advice. But I think hopefully today's episode it's very simplistic what we've discussed, wage versus dividend, but hopefully it gives you an insight into just kind of the importance of how you pull out of money and how you can save on tax and how a tax planning process is
very simple discussion in these elements. Obviously they can get quite complex, so it's one to visit with your accountant and draw it out and map it all out for your personal circumstance.
Amazing. Well, thanks everyone for tuning in. Hopefully you got a lot of value out of this. We are on YouTube, we're on Spotify, we're trying to be everywhere. So a review, some feedback would be fantastic. So look forward to catching up again next week. Thanks again.
Thanks a lot. Bye.
Bye.